He said, Guffy, you don't get it. Every $15,000 of insurance premium at a 6% cap eats into my NOI and costs me $250,000. I said, okay, so this is costing you $500,000. He said, yes. I said, okay, let me get with the lender. Let's negotiate out XYZ. Let's move around a couple things. Let's see if we can do this or that. And within 2 days, we had a $60,000 savings on the table because we got the lender to agree to certain things. And right then, it went from a $500,000 loss where he was thinking, man, I got to ask friends and family to close on this, to now I get to do a larger distribution and have that $1 million swing. And that's when I got hooked on building value around the NOI of a real estate asset with the insurance being the lever.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Guffy Wright. Guffy Wright is a multifamily insurance expert of 20 years, or with 20 years experience, helping operators protect and grow equity. He built the Mahoney Group's real estate practice and to over 100 million in premiums, and has created tools that turn insurance into strategic advantage. And in just a minute, we're going to speak with Guffy about why your insurance broker might be your biggest competitor. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Guffy Wright. Welcome to CREPN Radio.
Darren, it's great to be with you.
Well, I'm glad you're here. I'm looking forward to our conversation. But before we get started, if you could share with the listeners a little bit about your background.
Sure. I started selling insurance at age 22 for the Mahoney Group. This is the only full-time job I've ever had. Dropped out of community college, got married young with no plan B, and just started grinding, cold calls, knocking doors, doing whatever I could to survive. And what pulled me into multifamily real estate was the people. I think they respected the hustle. And every deal mattered to them. It mattered to me. Every dollar mattered. And I became obsessed with one thing, and that was how few insurance decisions could create or destroy millions of dollars of value for real estate owners. So that's what we've built the whole practice around. And then over the last several years, our practice has grown from 50 million in premium to over 150 million in premium by really focusing on one thing, and that is what our owners value and how we can convert decisions into equity outcomes.
Well said. Well said. So let's talk a little bit about the growth there. It sounds like you said you were working with investors and kind of focused on that. And what was it that the multifamily insurance opportunity spoke to, or how did that speak to you?
Yeah, when I was young and knocking doors and at trade shows, they seemed to respect the hustle and could see past maybe a lot of other rookie flaws that I may have had. And so naturally, Had a lot of deals coming up that they felt like no one cared about as much as they did. And I had my insurance book that I felt like nobody cared about as much as I did. And we just connected. And I really, really enjoyed who these people are between the ears. And I loved their growth plans, talking about the future and growth and deals. And they'd send me opportunities. And I just gravitated towards it. So after I was in the business about 9 years, I made a strategic decision to only focus on multifamily real estate and continue to build value around that buyer.
Got it. And the Mahoney Group, tell me a little bit about the Mahoney Group. How is that set up?
We're based out of Chandler, Arizona. We have about 300 employees. We're one of the largest privately held insurance firms in the country. And we are privately held. 0% of our company is owned by private equity or public money. So we're really able to serve our clients in the way that we see fit. And we have a great leadership team. I'm grateful to be on the board and be a part of it. And it's fun. We wake up every day excited to serve our clients.
And are you guys nationwide or
We
how are
are.
you?
We're nationwide. And something unique about my book of business being in Arizona, 90% of my clients are outside of the state. Um, they have a lender in Chicago, they have a real estate broker in New York, and now their insurance broker, can be anywhere. And so I started that young, kind of a road warrior, and it's worked out well.
Got it. So you talked about how the real estate investors they admired your hustle and all that. Can you share with the listeners a little bit about how it is that you worked with these investors to you know meet them and not meet them but meet their needs?
Sure. So initially it was just okay, let's get less on price and out hustle your broker and be a better resource. But that quickly evolved because I was working on a deal in Colorado that was about a $50 million acquisition. And the lender, 2 days before closing, changed the goalposts on us and required a couple little things at the end. Well, that cost my client $30,000. Obviously, they were not happy with that and actually treated me pretty poorly, where I kind of had to step back a little bit and say, hey, we've been doing business for 5 years. Like, help me understand why you're so stressed out. This is a $50 million acquisition. I get it that 30 grand is tough, but like you're kind of acting like a child almost, right? And he said, Guffy, you don't get it. Every $15,000 of insurance premium at a 6% cap eats into my NOI and costs me $250,000. I said, okay, so this is costing you $500,000. He said, yes. I said, okay, let me get with the lender. Let's negotiate out XYZ. Let's move around a couple things. Let's see if we can do this or that. And within 2 days, we had a $60,000 savings on the table because we got the lender to agree to certain things. And right then, it went from a $500,000 loss where he was thinking, man, I got to ask friends and family to close on this, to now I get to do a larger distribution and have that $1 million swing. And that's when I got hooked on building value around the NOI of a real estate asset with the insurance being the lever. And so how to replicate and actually scale that is we hired a lender team here in house, where then we developed a lender waiver template together with Fannie Mae and Freddie Mac and other loan servicing companies, to where we know they just want to check a box. That's what the lender wants to do. And so we help them feel very safe in doing that through data, through our process. And there's some things the lender requires, this as an insurance guy, Darren, there's some things the lender requires that it's doesn't even help the client. And then there's things they don't require that the client should actually buy. And so we kind of use that as a massive lever to negotiate out coverages with lenders because they're the ones holding the bag. But our clients have felt for years that they're not in control, but they still hold the keys. They just need a broker that understands how to navigate this process, that has a repeatable system that doesn't put their asset in more risk. They just receive more NOI.
Yeah. No, it's always kind of underwhelming. And I say underwhelming when insurance is just viewed as a line item
Yeah.
expense. I can't tell you how many times people go, well, how much is it per door? Well, that's not the way. I mean, appreciate that as far as your math, but that's not the way that the
Correct.
insurance is figured out. But no, and good on you to dig into it and kind of bridge the gap between the borrower and the lender, as opposed to just being the source of frustration.
Yeah.
I know from personal experience that's always a more appreciated uh, viewpoint when you can be a part of the solution rather than the problem that everybody identifies the insurance. And
Hmm.
so, well, that's interesting. So, is that kind of the primary vantage point where you have been able to kind of hone and create value? Is that understanding what the lender wants? Is that a lot of what you bring that makes it work?
I would say that's a big piece that a lot of brokers don't work together with their clients with. And it's more reactive. We take a pretty proactive approach there. But I would say that's a major differentiator. That would be number one, having a full lender team in-house that helps navigate the complexities of lender requirements and things like that. But there are two or three other levers that we really like to pull, and it has to do mostly with either a master policy. I don't know how technical you want to get, but a loss limit policy. So if you have $500 million of value in multiple states, you should probably only carry about 200, $300 million per loss. And we can get lenders to agree to that with some modeling and some data. Another big thing that we do with our clients is, if I was a real estate owner, I would do the same thing. So I don't blame them, but they really need to stop grading their own papers. And what I mean by that is, hey, I saved 10% this year. Great. And they're only comparing themselves to themselves. And I would do the same thing if I was a broker. That is a good data point. Don't get me wrong, if I was a real estate owner. However, we have benchmark data that we use multiple data points from across the country. And we have a benchmark report to show you what your peers are paying, what your peers are buying, how much limits they're carrying. And that way you can make more informed decisions, because if I save 10 or 15% right now, okay, great, I'm happy. But what if your neighbor only saved 5%? You would think you're doing great. Unless your neighbor was already 50% below where you're at. Now you don't feel so great, right? And so having that extra lens into what your competitors and peers are paying really helps you understand how you're really doing when it comes to not viewing insurance just as a cost, but as a strategic lever to separate from your peers, to increase the NOI, and to take back control from the lender. We like using the benchmark report, and we deploy that often.
And is the benchmark a reflection of the client, the book of business you have, or is it
So
broader than that?
we're part of a large group called Assurix Global, which is a conglomerate of privately held agencies throughout the country, and we share data inside this practice group. And so you're looking at a data sample of about 80,000 units across the country.
Got it. And then as far as you mentioned the lending team, are you guys, do you have a lending arm, or is this more a matter of the familiarity with the lenders and how they want to work?
It's the familiarity with the lenders
Okay.
that we don't just say send us your requirements and then quote. It's a, hey, send us your requirements. We know what the Fannie Mae and Freddie Mac standard is. Um, these are their requirements. Send us anything different. Send us your requirements, and then from there we start negotiating out with data and strategy with the client. Like, hey, is this coverage important to you? Here's why I think it is. How do you feel? Because everyone has a different risk tolerance. Everybody values different things at different times for different reasons. Um, and it's funny, I've never had a client, an owner, call me in the middle of a bad claim saying, Guffy, can you shave 10% off your premium, please?
Yeah.
They
Yeah.
don't value it at that time, right? They
Right.
value, man, I paid X amount for this contract. Please deliver. Like, what do we need to do to get this done and make sure that it doesn't affect our NOI and take up time and drag? So value is in motion constantly. And you have to know what you value. You have to know what your clients value because that could change based on the day. And you have to lead out front. And that's the same thing for real estate owners. You have to know what your investors value. Because if your investor, your ideal investor is going to retire in 5 years, well, that's a different way to talk to them as opposed to somebody that is looking for just something steady and 8% return, or maybe somebody wants to be involved and wants extra communication. Like it's really important to know what humans value. It's always in motion though. It's just if you think value is fixed, you're just wrong.
Yeah. No, that makes good sense. Guffy, you mentioned, I think you said a $50 million deal, and I think there's maybe even a $500 million deal. What's a range of deals that you typically work on?
Yeah, I like what allows our team to do our best work are people in growth mode. And we define growth mode as 500 units minimum a year or more. So whether you have 500 units or 1,000 units or 1,500 units, that's not as important as your growth projections. Our value is built around people in growth mode that maybe have a lean staff or company, but they want basically someone almost on their team as a partner. And so if you're in growth mode and you have 1,000 units, those are the people we really exchange value with on a daily basis.
Right, right. And so I would assume primarily those are more, um, what am I trying to say? What's the syndication type
Yeah, I
models
would
or
say it's
yeah,
it's yeah,
yeah.
syndication type models, all private equity, um, property management companies that are trying to grow and acquire units and want to use insurance as a value add. Um, yeah, those are the type of the people that we seem to do the best with. Yeah, you nailed it.
Okay. And as far as you mentioned a master policy, if you could take a minute and describe for the listeners how that works.
Yeah, master policies are back in vogue. And what I mean by that is the last 4 or 5 years, we were in a very difficult marketplace where insurance premiums just went up and you had to be super resourceful and maybe different effective dates and different carriers. And you had to kind of play this whole shadow game. And what ended up happening is insurance just became a big point of friction between clients, real estate, insurance brokers, lenders, all this stuff. And now the insurance market is going down. Premiums are decreasing on the property side in a significant way. And so even if you don't have a master policy, it's crucial you have a master date. So you can do this all at one time. Otherwise, you're just going to hate insurance. And not that you have to love it, but at least be strategic about it. So what a master policy does is it's one policy number for all of your account, all of your properties. They come up at one time of the year. And if you're doing a bunch of ads or deleting, it just makes it a lot better from administration side. You can also build a matrix. We build matrices for our clients that say, hey, when you're underwriting deals, this is what you can put in your pro forma based on your master policy. So it's important to get at least a master date minimum. If you don't have 1,000 units and maybe a master policy doesn't make sense for you yet, that's fine. Get a master date so your insurance broker and you can do your best work once a year. I mean, imagine if you had the toughest deals you had to buy and get strategic about. Imagine doing that every month. It's not fun. Doing that once a year, gearing up for it, and really getting strategic about it is the absolute best way to approach your insurance at a minimum.
Yeah, amen to that. The having multiple conversations throughout the year and confusing what's what is not ideal for anybody. Whereas if you have that master date and you have the one comprehensive conversation that addresses all aspects, and then also, like I said, gives you the benefit of being able to add properties throughout the year to that just the ease of doing business for everybody involved is definitely much preferred. You mentioned also the stop loss type policy. Can you describe for listeners a little bit about how that works?
Yeah, so a loss limit policy is If you have a $500 million portfolio, we would model that and look at your maximum probable loss based on the last 1,000 years of weather patterns and data. And we would tell you, okay, a loss limit for you, maybe $250 million shared between all of your properties. And that way you can reduce premium by doing that. Now, most of the risk is loaded in that first 10 to $15 million of value. So it's not like it's 50% less. But that way we can drive down the values per location on a replacement cost basis because it really doesn't matter. You have a $300 million loss limit no matter what. And so because of that, it doesn't lower your risk. It just gives you more tools to drive up the NOI. And it still is a safe policy to have and quite frankly, very common as long as you have the data to back it up from our RMS modeling. And everybody that's listening, your broker can get that modeling for you so you can really make a strategic decision that doesn't put your investors at risk.
Right. And then can you also talk a little bit about the uh, the carriers that are providing these types of excuse me, these solutions? I mean, can you describe for the listeners how I mean these aren't typically the brands that people have that they're familiar with. I mean, you talk a little bit about some of these master policies and how they're
Yeah.
structured and
So the few brands, you're right. There's only maybe two or three brands people would be familiar with that do these large master policies. And if they do it, it's typically Class A stuff. Um, those those are like the main, that's a Travelers. They can do some of that. But what we're talking about is typically a non-standard carrier that is a Lloyd's of London type based either carrier or syndicate, and you layer multiple carriers up to that loss limit. And it makes sense if you have typically around 200 to 300 million of value to do that. You will get a carrier that is a non-standard carrier or a carrier that's basically a Lloyd's of London carrier or subsidiary of that. And from there, it's really just important to have one claim adjuster named in the policy in case it pierces through multiple limits. You're not dealing with multiple adjusters and you can just be a nightmare. And so that's something that a expert broker will know and will educate and guide you if this policy is attractive to you. Um, Another thing, and I know you didn't specifically ask about this, but we like to go direct to Lloyd's of London, and we own a brokerage, 10% ownership in a London brokerage, where we cut out the domestic middleman, fly out our owners that have it, typically works around 5,000 doors, and we go cut a deal right there with the underwriters in London on these loss limit policies and things of that nature. And it's a really, really cool experience for the owners because they get to see how the insurance business actually works and at the same time develop relationships face to face with underwriters. I once had a client tell me, I've never met an underwriter. Are they even real people? You always blame the underwriter, this or that. It's just like, you know what? They actually do have a soul. They are trying to do their job. They are real people. And at Lloyd's, we can meet them face to face on these loss limit policies. So there you go.
now and can you talk a little bit about you mentioned like the A plus which is typically a newer class A property, but with regards to some of the non-class A, maybe B, C class or just older, can you talk a little bit about what the underwriters are looking at as far as the characteristics of the
Yeah.
property and their concerns?
Well, if we can get them to look at it, these older properties, here's what they first look for. Wiring. That's the first thing they look for is if it's aluminum wiring, if it's has Pacific panels, Zinsco panels, that's a problem. So I think wiring is the biggest thing. If you're looking at deals to acquire, make sure in your due diligence, you know that that wiring is either copper or that if it's aluminum, that it's been pigtailed or retrofitted. They also look for updates. I mean, it's important to know if the roof is 2 years old or if it's 10 years old, especially if you're based in Houston. It's also important to know your own track record. Hey, how can we set this how can we set this portfolio apart from every other submission that this underwriter has seen today? And you really want to make sure that your broker knows how to tell your story and knows exactly what underwriters are looking for, because how you frame their policy and their story is going to be a direct reflection on pricing. Don't let your broker tell you that everybody gets the same pricing. They don't. Don't let your broker tell you everybody has the same markets. They don't. Um, you know if your broker's a specialist, just like you know if your attorney's a specialist. If you're in a bad situation and you get sued, you're not going to hire an attorney that doesn't know anything about landlord law, especially in the state that it happens. Because I promise you, California has different laws than Oregon, and Oregon is different from Washington. I can tell you two big ones. Um, Washington has a pretty nasty law that you don't even have to be at fault and you can still pay for the whole claim. California has a law for habitability that you can get in a class action lawsuit for all the tenants saying it's uninhabitable. There's just so much you need from a specialist. And it really, honestly, it used to make me upset. Now it just breaks my heart that a lot of real estate owners use specialists for everything except insurance. They still go to people that insure the country club or insure the ice cream shop and a $40 million asset. It just blows my mind. Use a specialist, please, for me and for Darren, if not for yourself.
No, definitely true on that. Um, so talked a little bit about the age and the updates and that. Are there any, and also you mentioned how rates are starting to come down, which is definitely a welcome thing, having been through the last couple of years. Um, my question to you is, are you seeing that being a universal decrease, or are you seeing underwriting still, uh, lean into more desirable properties and better pricing versus ones that can't provide all the answers to all the questions, not getting as much of a price relief?
Well, I'm glad you asked that question because it does vary. And right now, the news out there is, hey, insurance rates are down. And that's not true for everybody. The Class A properties, they're already priced thin and getting a great deal. So if you're with a well-known company like a Travelers Nationwide, um, you're probably going to get flat or maybe a little bit of an increase. But if you are a Class B, Class C property built before 1990, let's say, you're absolutely getting a decrease. You have been raked over the coals the last 4 or 5 years, and you are absolutely getting a decrease on the property side, not the liability. Liability's flat to up. And also the biggest decreases we're seeing are for people on the coast, Florida, Texas. We're seeing 40 to 50% decreases regularly there. Um, and so, yes, it does matter. It is different. If you have a bunch of Class A properties, you're flat. If you are on the coast or you have older frame apartments, you are seeing an overall 10 to 25% decrease. Absolutely.
And can you speak at all to any of the, um, I'm going to say well, first of all, the wildfire risk. I know that's been something that's been drives a lot of rates for us. Are you seeing, are there any specific type of events that you're seeing carriers are still cautious to proceed with?
Wildfire is still a challenge for sure. In fact, even tighter in a lot of areas. Section 8 housing is still tough. Um, while property rates are down for a lot of those older Section 8 properties, like I just mentioned, liability rates are still really high and they're going up. And one of the reasons it's tough is because we talked about the lenders earlier. The lenders are really liberal right now on property to negotiate out property terms. They're tough on liability right now. They're not easy. So especially if it's affordable housing, and you know what, you need the coverage on assault and battery and sexual abuse and animal dog bites, and it's those Section 8 properties are tough, and there's restrictions. They just can't raise the rent to cover for the loss of NOI. So those are ones I really feel for. But wildfire, yes. Section 8 properties, yes, those are still tough. And if you've suffered a loss and if you have bad loss history, you're not being rewarded for that. Those properties are still going up. So if you received a non-renewal, that still puts you in a kind of a vulnerable situation, even in this market.
Yeah.
Would you agree with that, Darren?
No, totally. The property rates we are seeing, the rates coming down on, and these are the properties that have been just getting hammered here the last couple of years. I mean,
Yeah.
50% rate increase. And there were a couple of years there where we were just like, hey man, here we have a renewal. There's no other options. This is what you get. But yeah, and that's kind of the elasticity of the market. I think people always assume that things only go up, and especially when they're going up, there's a lot of frustration and people aren't really happy to talk to an insurance agent at that time. But when prices come down, they tend to forget that. They only remember the increases. I think the other thing I was going to ask you about is, so while prices are going up, I know one of the strategies that either the carriers or my clients have engaged in is saying, okay, we can do without that. Let's pull that. We'll pull this. We'll pull that kind of thing. But while the price is coming down, what I'm seeing is that some of the carriers are now adding back in coverages, and or the clients are adding, saying, okay, let's add that coverage back on. Have you seen any of that in your experience?
I have, especially if you have like a refinance coming up and loan proceeds are crucial. Um, Different decisions are made at that time because people value different things at different times. The wind and hail deductibles are a big one in the Midwest. If you traditionally had a 5% wind hail or a $5 million wind hail, and now you're at a 3 million, you're feeling really great. But if you're still at a $5 million deductible on the wind hail, but your premium's down 50 grand, you kind of go, huh, maybe I was able to survive this last year and it was great and it was okay. But man, what if we brought that down from 5 million to 2 million? What would that cost me? So yeah, they're starting to ask for more options to include coverage as opposed to just like, man, how do I do this? And so, and insurance is a big line item for our people here. I mean, it can turn a refinance, I mean, into a massive loan proceed and value situation. It can also wreck your asset. If you suffered a big loss and insurance doubled, I mean, it could be the difference between a capital call and distribution to investors.
Yeah, yeah. That's unfortunate, and that's the market. I feel like in recent times the pricing has been more elastic, and I don't know if that has to do with more with the data. I do feel like, and I've said this a lot, that every keystroke I've ever put into the computer is now being used against me, because I
Sure.
feel like the data scientists have now firmly grabbed hold of all the data, whereas before it may have been more anecdotal and underwriter reliant, whereas now a lot of it's algorithms and that. But I mean, I don't think that insurance is unique to that. I think that's surge pricing with everything else that's going on as well. So kind of just
I
a
would
sign of
agree. And
times.
I think people like us are very valuable if we can make that complexity simple
Yeah.
and not overload our buyers because it is very complex, just like their deal is very complex. But the more we can simplify, because we're going to get cognitive overload from AI and data, and so are the underwriters, and so are our clients. And so, how do we simplify? I had a meeting the other day with a global real estate company, and they were testing us. They started it by saying, "Hey, Guffy, we have property in Australia and France and Mexico. Is this something that you think you can handle? And I had to make it really simple for them. I didn't go tactical. I said, whether you're in Australia or going to Mars, it just comes down to risk and exposure. So let's get clear on what your risk is, how much exposure do you want, and we can tolerate, and then we build our whole story around that to the underwriting team. And that
No,
landed really well.
yeah, no, that's good. That's good. Um, with respects to working with an investor or insurance buyer, um, what are your recommendations for information that they need to provide, as well as the time needed to underwrite in order to get the best pricing, best opportunity, best offer?
Well, it's not unique to other businesses. The more that truth is told, the more transparency is delivered, the more safety is tested and expanded, the underwriter will deliver better results. And so the game some people play, insurance agents included, by not sharing information and not giving this and trying to hold everything back. And then, so somebody has to trust first. And I would say the insurance broker should trust first and tell them what they would do, even if they don't use you. But then we also need back from you the truth, everything, because the more truth that is told, the better the outcome is going to be. Um, and so that's what I would ask. Say, hey, if you're working with somebody else, you got to tell me. If you have a different mindset on how this should go, you got to tell me. Here's the information I need that allows me to do my best work. And this is when I need it by, and this is how we're ultimately going to strategically align. And the more transparent we can both be to each other and have that trust, then we can really decide if we have alignment or not. And that would be something I would do if I was a real estate owner, knowing what I know. I would be completely transparent with everything and trust that you're using a specialist to negotiate the best deal for you in the present and the future.
No, good insight there. Hey, Guffy, if we could, I'd like to shift gears here for a second.
Let's do it.
Um, so this is a little different with you, given that we're both in insurance. But the my little spiel goes like this. By day I am an insurance and broker, and I work with clients to assess risk and determine what to do with the risk. There's three strategies we typically consider. We first look to see if we can avoid the risk. If we can't avoid it, we look to see if we can minimize the risk. And if we can't avoid nor minimize, we look to see if we can transfer. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, could be their investors, their tenants, the interest rates, or the political winds, whatever it is, that you can identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Guffy Wright, what is the biggest risk?
The biggest risk is apathy, status quo. If you don't have clarity, safety, and direction on a large and spend on your asset, I think that's the biggest risk, is apathy, not treating insurance like you would your own debt and your own clients. That's the biggest risk.
I like it. That's good. That's good. Guffy, where can the listeners go if they'd like to learn more or connect with you?
I am on LinkedIn and respond within 24 hours of any message or any connection. So if you have any questions about your growing portfolio, would be happy to answer those, and no strings attached. I have a website that's on my LinkedIn profile that if you're curious, you can go to that and upload your statement of values, and we will generate an executive summary on what we would do if we were you with your portfolio, and we don't ask for anything in return. So that's where you can find me. And if you thought there was value in this conversation, that's how we could get discussing the next steps.
Got it. Well, Guffy Wright, I can't say thanks enough for taking the time to talk. I have enjoyed it. I've learned a lot and look forward to doing it again soon.
This was great, Darren. Thank you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.